Right. Okay, guys, confirm that you can see my screen at the in front of you. My mouse is also moving on the screen. We're going to start with risk management. Very, very important stuff. This one, probably not the most exciting one, but at the end, we will do a chart and stuff where we can show some example of how this thing actually works. But for now, I just want to get it into you guys that the risk is a very important issue. Right, so if you ask a retail trader how important risk is in trading, then it's going to be like a non-issue for him. You know, it's something very small, something that we don't even need to think about or bother with. But then when you ask a pro trader how important risk is, then for him it's one of the most important things. It's a massive deal. It's a big thing. In trading, we have to manage it ourselves. The brokers gives us full autonomy to manage our account, and we can risk as much as we like. It falls, part of their business plan, trying to let us turn around our accounts very quickly. We open an account today, and within a few days, we just blow our accounts because we don't have risk management. Now, the pro traders, they have a corporate environment where they have a specific risk department that manages the funds in the account, whereas we are left, to our own devices. We can do as we please. But whenever a pro trader needs to take any sort of massive positions in the market or any position in the market, it has to go through a risk department. They have a department that is dedicated to this issue. It's that important. This is the reason risk management falls, as part of my secrets to trading success. In the very first lesson, I said that psychology is number one and the risk is number two. Now, the reason the risk is number two is because you're going to need your psychology to be right first before you can even start thinking about risk. Because we were mentally wired and programmed that the higher you risk here, the better it's going to be, the quicker you're going to make more money. The immediate gratification thing is what all retail traders are after. So without the psychology put right there first, we're not going to bother with risk, which is the second most important point for me. Now you ask the same trader on how much to risk. The first question was, how important is risk? This one is, how much should I now risk? Then it will be a massive big thing here. Risk as much as possible so that we can grow our accounts quicker. The immediate gratification. Then you ask a pro trader how much, then it's a small amount. The reason it is small for him is because of the risk department and also the investors who's probably investing in the hedge fund. They would then phone the hedge and ask about what is at risk today. Not really bothering about how much profits are you making today. They are more concerned about how much money of mine are you risking today. They know at the end of the period, which is usually a quarterly period, they are going to pay out any sort of profits that the hedge fund made. But almost on a daily basis, the investor calls in the fund and the fund management asking how much of my money is at risk today. So the pro trader is going to risk small, whereas the retail trader, you ask the retail trader, then he will want to risk big. So it's always that two clashing against each other. Yeah, it's always the retail traders they really have the wrong idea here. So what are we trying to do here at Pure Trading? We want to balance this whole idea. We don't want to risk too much to fall into the category of losing all our money and in a very short space of time. The 90-day issue: open an account in 90 days. Within 90 days, you're going to lose all that money. And also, we don't want to risk too little where we are thinking that this is nothing and that we'll never be able to make any sort of a living doing this. Because I'm sure everyone here wants to trade for a living. So if you risk too much, it's not going to work. And if you risk too little, it's not going to work. So we're going to need to find a balance here. And that's what I'm trying to do with this lesson. But in the beginning, we all have this training wheels on. And I suggest we keep the training wheels on until we prove to ourselves that we have the ability to stick to the strategy or a strategy through thick and thin, whether things are going good or bad, and then measure that performance. That is the training wheels. Keep them on until we start risking anything more. So I'm suggesting at the beginning, keep those wheels on, risk the lowest lot size until you reach about 10% of your account. Then this way, you will know whether you've mastered the strategy or not, because you can't get 10% in by just taking one or two little lucky trades. We want to see that series of trades. We want to see a number of trades, and those small number of trades is what we are after, and we're gathering that information. Yeah, we are working towards maybe 100 trades or more on a low lot size to get to 10% as a goal. And then that is the point where you can start removing your training wheels. So at the moment, the balance is probably not going to be as like we want. The balance is going to be more to the low risk side of things. Like it's going to be, you're going to think that it's probably too little. Yeah. But in our journey to get it balanced, we're going to need to do it this way. Keep on your training wheels and gather a lot of statistics and get to the 10%. And then we can start thinking about upping that figure again. So this one size fits all figure that when you learn risk management online or in many courses, probably all the courses has the same figure. Now, just type in the box. I've already went past it, but just to see what your figure was, what your education was up until now. What is that figure that always comes up when they say, what is your amount that you are supposed to be risking per trade? You can just type it in the box. Yeah, that's it. It's like between 1 and 2%. That's exactly what they say. But I don't know where that figure comes from really, because I don't know of any hedge fund or hedge fund manager that is going to approve a 1% per trade risk. So what we're trying to do here is trying to get rid of the 1% per trade issue. Because one size does not fit all. Yeah. So the 2%, 1% issue is not going to be what we're doing here. There is the book Zurich Axioms by Max Gunther. He says, worry is not a sickness, but it's a sign of health. If you are not worried, then you are not risking enough. So that should make you guys a bit more happier. It says, oh wow, Rustam is promoting higher risk here. higher than normal. But it's not the case. Yeah, I am not promoting higher risk. What I'm saying is we need to find the balance where we are still worried about that amount, but we are not going to lose any sleep over the amount that we are risking. So the way we're going to do it to try and find that balance, and this is all after we have our training wheels on, and we still have our training wheels on until we reach our 10%. Yeah, this is after we reach our 10%. So what we're going to do is we're going to find out what it is we spend on a daily basis. I'm just reading the questions here first quickly. Jahirul says, a hedge fund manager once told me you want to give yourself 40 attempts with your account, which is just over 2% a trade. Yeah, but I'm thinking about trying to find out whether you have mastered your ability with your strategy. And I feel that 40 trades are too little. I don't know, by now you guys must have taken more than 40 trades already. So you should know what the win ratios are and all that. What I'm suggesting is to try and find out your balance here is to work out what it is you spend per day on average for coffees, for lunches, for drinks or whatever, and then supper perhaps. So if you are spending like $90 or something, and you divide that number by 3, and then that is a nice amount to start off with risking per trade. It's something that you care about. It's as if you are giving up a burger or something that you are used to having, and you're not going to lose any sleep if you didn't get this coffee or whatever, but feel something, attach that risk to a particular thing so that you can feel that you actually care about the amount that you are risking. But this is all after the training wheel stage. First, we need to find out whether you are able to stick to the strategy and whether the strategy is a good fit for you. And then afterward, then you start looking at the risk issue and how much to risk. And for me, this is a good way of finding that balance. And I don't think this type of thing is shown or taught to anyone, but this is from Max Gunther. And I think that, I mean, a lot of Swiss banks here, they really use this Zurich axioms as like their risk management Bible. And I think it's quite a good one. Yeah, maybe you should try and get hold of that book. And then the personality also, like Johiru is not the same as B, and B is not the same as Mark. Everyone has a different personality. So when we are aggressive or conservative, I mean, we're not going to be able to change this innate nature in ourselves. So it's going to be a constant battle with us. Like my battle with risk management was quite a long one. I couldn't find out, the correct figure to risk and all that. I spoke to a lot of people to help me, but the answer is definitely inside. It's within yourself. But then still bear in mind the training wheels. Just keep that wheels on. That is my suggestion to you till you get this 10% first. Then start risking that 10% in your account. You'll feel much better. You'll feel that you've grown your account and it's the market's money that you are now risking. So just keep that standard. Well, what I'm trying to suggest to you is this is all after the training wheels has been removed now. then you can start thinking about personality and all that, because now everyone is in a hurry to start growing their accounts. But first, make sure that you are able to remove those training wheels. Yeah. So personality plays a very important role. It's to find out for us traders whether you are aggressive or a conservative trader. And the way that we're going to do that probably is going to be something like this. Let me just see if I can ask you guys inside here just to see. Okay. Made it. Yeah. Okay. So prices are moving upward now. Yeah. And it looks as if we are trending. So we're making higher highs and all of that. Yeah. And then it gets to some sort of a barrier and stuff. Yeah. Yeah. And we are past it perhaps. So now we get lows and up, right? And we're looking to trade there. So how many of you would want to take that trade when prices comes down through here like that? Would you take this trade coming down here? Okay. And then prices goes further up here, comes down. Let's say there's another barrier right up here now. Yeah. So would you take your trade here, putting your stop loss above here, or would you take a trade there, putting your stop loss here? If you take this trade, your risk to reward, because our target is down here, is much better. If you take your trade here and your stop is up here, your risk to reward is big. You have a bigger risk here and your target is less. So that is number one, and that is number two. So where would you take your trade? Can you just write 1 or 2? Okay, Alex would take number 2. Johiru and everyone seems to be wanting to take number 2. Is there anyone here that would take number 1? No. So it seems everyone wants to take number 2. So what do you think? Who's more aggressive here, number 1 or number 2? Okay, number 2 is definitely the more aggressive one, because he's taking the trade. He's taking his trade up here, and he's putting his stop loss up here. You know, he wants a very tight stop loss, whereas the conservative guy is taking his trade. He really wants more confirmation that it's coming all the way down first, and it's going to click him in, and he's putting his stop loss even higher than the first trader up here. So number 1 is conservative and number 2 is aggressive. I was hoping to get a more like a I was hoping for more people to choose number one so that we could, look inside of the aggressive trader and then look inside of the conservative trader. But you need to be honest, because this is just a drawing year. So I'm thinking of maybe for homework, find out which of these sorts of trades you would take. Would you take the trades year or year honestly when it really presents itself? Because then you'll find out whether you are conservative or aggressive. Because the way you take your entries is going to be usually the way you are, really your personality. I'm an aggressive trader. I know this about myself. I just need to know how to manage the risk as an yeah, that's good, as long as you're not wanting to change, because you don't have to change your personality with the trading. Yeah, that approach that you have is a much better approach. The next slide really takes that into account, that your emotions and your personalities and stuff cannot really be controlled, but they can be managed. So what we need to do is learn how to manage our emotions, and then in that way we learn how to manage our risk. And how do we do this now? How can we manage our risk better? We are going to use a plan to manage our risk. This forms the basis of all everything that has to do with risk management has to fall under a plan that's already pre-thought of before you even went into one particular trade. Before you've risked any amount, you needed a plan beforehand. So how do we manage our plan? We need to understand that the zones are not all made equal. This is our resistance level here. And then this is also a trend line, which is also a zone. And then this here is our support level, which is also a zone. But these are not made equal. So it depends on the time frame. So if this is on a weekly chart, then the zone and the level becomes more important, because we have more people looking at it, and we have the bigger guys with the bigger accounts looking at the higher time frame. So the higher the time frame, the higher the more importance we put to the particular zone. So if you find yourself at an area where you're on a monthly chart or weekly chart, then have a standard risk in mind on your plan. If you are a 0.5% trader, then you risk 0.5% at these sorts of levels. You can start off with that amount, 0.5%. And then as the time frame drops lower and lower, you need to associate that with level becoming worse. The probability of those levels are becoming now less and less that it's going to work out. So if this happened then on a 5-minute chart, then instead of risking 0.5% here, you're risking 0.1%. That's an example. So the plan that you have needs to be a rigid plan. It needs to be something that you stick to. You don't deviate from the plan when it comes to the amount that you risk. In the very beginning, I asked you guys to send me the the trading plan. So now you need to, for homework, send a different trading plan or the same one that's modified with more rigid rules. Yeah. When I get to a weekly chart and the level is good, I trade my standard risk, which is whatever, 0.5%. And then this is all bearing in mind that your training wheels are now off. The more confluence there is in the level, then the better the probability as well. So you have to have a gold standard. First, the level is very important. So I'm risking my standard level. And I'm going to suggest not going more than 0.5% if you're going to take up the whole fund management route. Never go above the 0.5%. Make that your complete, your best, your gold standard, your best level. Yeah. So time frame, the higher, the better. The more confluence, the better. So at this level, you're finding yourself at a confluence with more levels to the left. And at this level, you also have an EMA there. And at this level, you have an extension beyond the mean. So it becomes your gold standard level, 0.5%. You can say that if prices are trending, then I'm going to be, I'm not going to, I'm not going to think of the risk as my standard risk. When we are trending, I'm going to do it a lower risk. Or you can have it equal, depending on the time frame. Mine is equal. When this on the same time frame, there is no difference between my risk between a horizontal line here and a trend line on the higher time frame. But you need to have this in your trading plan so that whenever something comes up, you know exactly what it is you are going to do and how much you're going to risk. And in that way, you will be managing your emotions and managing the personality that's already, innate in you. So you're not going to sit there not knowing what to risk when prices hits a certain level, and you're not going to be moving the stops around or adjusting anything, because your plan says when it hits the weekly level and I'm dropping down to the 15-minute for my entry, I'm acting off of a weekly time frame, and I'm acting off of a confluence that I can see on the weekly chart, which means my risk is my standard 0.5 risk. So when time frame and confluence are matching, you can risk higher, and the highest one is your standard, your gold standard. So it's a predetermined in your plan. Don't deviate from that for at least for a good while. So now you've decided whether you're an aggressive trader or a conservative trader. This is in your plan. Before doing anything else, you already know what your risk is. Yeah? Your personality is going to be, and your emotions are going to be managed by these numbers that's predetermined on your plan. So when it comes to your chart, you can just act when you need to without thinking. Is this a good level or not? Or it's a good level. It's reached the weekly and you've got 2 points of confluence and you have many touches to the left. So the quality of that level is good. Then if you're an aggressive trader and the quality of the trade deteriorates, meaning that you're now finding less confluence, then you can drop half of your standard amount. So if you're an aggressive trader and you want to trade for 0.5% at a good level, it means that as the quality deteriorates, you now drop down to half your standard amount, so 0.25. And a conservative trader, if his standard trades are at 0.2%, he halves that as the quality of the trade becomes less. Does that make sense, guys? So the first thing is to leave those training wheels on until you get 10%. Find out whether you are an aggressive trader or a conservative trader. And my suggestion is not to trade more than 0.5% per trade. It gives you enough room to continue your practice, even though your training wheels are now off. Jahiru, what do you think? Because I know you've determined that you are an aggressive trader already. So, and I know 0.5% doesn't sound much to an aggressive trader, but bear in mind that the strategy with your 6 different entry levels now becomes much, much more, because you've got so many chances to get into a trade that trading 0.5% is even a lot. It's even aggressive, because you can find a lot of trades. You can ask Gavin now. Gavin is, I've done the homework portion with Gavin yesterday, and he's shown me such a lot of opportunities at a certain level that he has found. So for me, 0.5% is a lot. Taking 2 trades is already 1%. Yeah. So this is a big number. And I think Alex also, the younger you are, the more you want to risk. I think he's the youngest in the group here. This guy's thinking 0.5%. I'm getting out of here. I'm going to look for somewhere where I can risk 10% per trade. Because Alex was the first one to actually qualify. You remember the very beginning, we had to qualify or we had to show that we can hit 10% on our account without drawing down 4%. Alex shows us 12%, but he's drawn down like 9%. So I hope that this is going to put him on the right path now. Yeah. So nothing more than 0.5%. I'm suggesting, 0.2% as your gold standard. Yeah, just until you can qualify yourself, feel that you know how to trade with these small amount, low risk, low lot size, 100 trades, and you hit 10%, then you know you're good, man. Then you know you're good. Whereas if you're trading one trade that's 10% and luckily you've made it, but you don't know if the strategy works for you. You don't know if you can apply the strategy properly. If you do it small, then you will be able to test yourself properly. And then we're going to go to the chart. All right, can everyone see my chart there? Okay. All right, so we have the euro New Zealand this time. Yeah. So the ideal situation is, this is definitely not an ideal situation. I've chosen this one because it's not ideal. Yeah. It needs to be a difficult one. So everyone knows how to do this by now. So we're looking for our levels. We're finding levels to the left, and then with our resistance, we're also finding levels to the left, and we are looking to the right here, checking whether we have a nice figure. 7530 would be a good one there, and on this one, maybe down toward the round number 1.6700 there. So now we need to bear in mind that this was our ideal spot to get into a trade on the top here. Yeah. And then if we look to our date here when this happened, around about mid-October. Yeah. When we started becoming interested in this trade. We're looking on the daily. on the standard chart, and then we see our mid-October is round about there. There's an excursion beyond the mean, and there's levels to the left. So there's confluence in the idea of going short. Then what does the weekly give us? The weekly says if we get in here, our target is about a 800 pip move. So our first idea is getting into the trade here based on an excursion beyond the mean, which happened here. So it's identified on our classic charts. And we have an 800 pip move to go down. So just looking at this, we wouldn't know where our goals and things are. So that's the way we're going to combine the two systems. We're combining it into one. And when we get in on the top here, we're getting in based on the market state in a range up here based on this. But when we are traveling down, we are looking toward trending down, because the market is not going to range all the way to our goal. The market is going to trend. So if the market keeps on doing this, then it's never going to get anywhere. It's just going to stay where it is. What we're looking for is a move down. And that we are looking at trending. And when we're looking at trending, we're looking at the H4 chart. Yeah. So our first entry is that. And that was found on our standard chart. That there was found here on our standard chart, just here. So when we took this trade, we took it based on levels to the left. And we also took the trade based on an excursion beyond the mean. Right? And then that's our first trade, and we had our stop up here somewhere. And we took our first trade. So what I'm suggesting here as a risk management strategy is to then take, if you've taken your entry here, and then take profits around about halfway through or not halfway, but a 1:1 or a little bit more than 1:1. And don't move this until your first profit has been taken. That's a suggestion for risk management. So get your 1:1 profit, and then don't move your stop until you've at least had that 1:1. Yeah, so far so good, yeah? So you've got your trade in there. So how do you get into your second trade now? This is where you found your first trade. Let us put a line here, demark that there. And then we're obviously going down to our daily now, right? So this is your excursion beyond the mean and all of that. And then you've identified some sort of a trending situation like this here. Yeah. Some trend that has broken. Yeah. And a nice help here is when you actually get a break of a trend of not a break, but a crossover of your EMAs. So the previous trend on the daily is going up, and you've gone in on a trade here, and then you've taken like a 1:1 sort of a situation. So you've taken 100 pips or more out of the market already. In this case, you've taken that profits and you've banked it. Then you're following the strategy now. You want to trend trade this thing down. So you find a trend line that is broken. This is a bad looking trend. Chose this example purposely. Yeah? So you can ignore this here, and that's maybe 1, 2, 3, 4, a few touches there, and then we have a trend line breaking here and then a retest up here. So in this area, we're looking for more. The better, the more conservative way is to wait for a trend line to break and then also have at the same time the EMAs crossing. So the conservative way is again doing it that way. Yeah, aggressively you can do it this way. Conservatively is that way. So again, coming to the style of trader you are, you need to tell yourself that you wait for crosses or you don't, but not that one day you do wait for a cross and the next day you don't. Yeah, you need to be consistent so that when you have your statistics, you know that you've always used the crossover first, or you've always never used the crossover. You've never ever used it. The idea is to be consistent. And then in this case, you have your trend line that's broken, identified on the daily chart. And then what you also have here are 3 touches or more going down. So it's really, and it's going parallel to the EMA here. Bear in mind that you've taken money off the market here already. You're confident in your trading idea. Your trading idea was one that you've entered a trade and you had your eyes set on a 800 pip target eventually, not all in one go, because otherwise you're going to feel frustrated if the market goes up against you and you never ever take any profits. So 1:1 or a little bit more than 1:1 at your first go, and then you can use that money, put it back into the market when your next setup appears. And your next setup is nothing else but a trend line break first and then a drop to the 4-hourly chart for your second attempt or your second entry. So here you have your trend line break now on coming from the daily. The prices are coming all the way down and it breaks through, right? And then the pullback. In this case, it looks as if the pullback has come, corresponding to the trend line from the daily. If you have a look at the daily again, here we have the daily trend line coming down and you have the break and you wait on the 4-hourly for the pullback. So this here is my second attempt, not attempt really, it's my second go at trying to reach the end target here. We've taken off 100 pips already from the market, right? So now we're looking for a second opportunity in this area. So this area has come up close toward a trend line and also close toward my 200 EMA. So I'm taking the 100 pips that I've made and I'm putting some of those profits for another trade. So I'm looking for manipulation here on the 15-minute. Yeah. Then my stop loss is up there. If you have a trend line and a 200 period moving average, make sure that your stop loss is above that area, right? And you find your entry over here, and then again 1:1 here. Yeah. Make your target at least 1:1 or a little bit more. And then as prices are coming down, it's making another break there. And then the better thing to do here is to wait until we have it lower than that. So it's broken this part, it's come down there, and then pulls back up and then trade again. Because we are trend trading it all the way down to here. And then risk less and less as things are getting closer and closer to the trend line here. That is one way of managing the trading idea. So initially your trading idea was to get in on the daily chart based on an excursion beyond the mean and all that, and then to trend trade it down. Now, there's another method of doing this. When you trade your first trade here on the top, when you trade your first trade here on the top, yeah, and you did your 1:1 or a little more, what you could do, and what B does as well, he would take more than one position here and then trail. So he would take 1:1 off the table or a little bit more. So he's traded there, and then he would, take 1:1 off the table on one position, but then leave the other one to run, and then just start moving the stop above the 36 EMA or above whichever trend line. So in this case, we can see there's a more conservative trend here, or aggressive trend here, which is going away from our EMA, which means now we need to start trailing it above that area, your second position. So you're taking in multiple positions on the top here. So instead of buying once, you're putting two positions in at the same risk, meaning if your standard risk is 0.5%, then you would take two trades equaling 0.5%, and you would take one position off the table at 1:1 or more. I used to use 1:1.25, and then I swapped to 1:1, and then 1:1.25, constantly swapping between the two. And I think that that is just the way, that's just the nature of this thing. It's because you're never going to, be 100% comfortable. Because you always, if prices goes your way and you have too little on the table, or you only have one position left, then you would always wish that you had more. So the idea is, before you do it, have that plan in mind. If you have the plan in mind initially from the start of when you draw up your table, then that's what you always do. You can also say that per trade, you're going to have a different plan depending on the price action here. But definitely before you pull the trigger, you should already know how many positions you're going to put on, and if you're going to trail or if you're going to add to the position. Yeah, I like using the multiple entries as well, Jahirul. So let's just go over this example again, yeah? So if you had 2 or 3 positions in the market here, you would take your first position off at 1, or at 1 or a little bit more, yeah? And there are those who also don't take anything off the table unless they've reached 1:2. So if you've risked 50, you don't take off anything until you hit 1:2. So you would have 3 positions in the market. Yeah. Let us just write this on the board. So if you have 3 positions in the market, yeah, it's all equal to 0.5%, right? So it doesn't mean you have 0.5 plus 0.5 plus 0.5, and then you have 0.75% or whatever. It's all equal to your total maximum risk. You take this as if it's one position. So now you enter your position here, and then that is your risk amount. And then you don't do anything unless you've hit 2 times your risk, which means at this point, when you take your money off the table here, then you can never lose anymore. You still have positions to keep on trailing the price all the way down. Yeah, so you can take your first position off. This is just to give you that peace of mind, the 3 positions or 2 positions that you have taken off some money off the table on your first entry. And then when it comes to your second time, you feel that it's okay for you to risk money here because you've already taken money on that initial move down. It's a way of managing your emotions, because we're not going to be able to control our emotions. We can only manage it, and the best way of doing that is by having a particular plan that you stick to. And when I mean stick to, you can still be, I mean, you guys are, I mean, you have lots of experience. Gavin has years and years of experience, but he doesn't have years and years of experience trading in this manner. So I'm going to treat you guys still as having those training wheels on, and suggest to you that you don't remove the wheels until you've qualified yourself, yeah, till you know how to stick to a plan. So take 2 positions if you want. Multiple positions has always been the best for me. Initial multiple positions. Then I don't need to bother taking another trade because I already have my initial trade in at the best possible price, which was here. So I have 2 trades in over there, or 3 depending on how far this distance is. If I have this big playing field here, I can already plan to myself that I'm going to have 3 trades in. Yeah, I'm going to take 3 trades when it hits this price again, and I'm going to take money. I'm only going to take anything when when it reaches 1:1 perhaps, or when it reaches 1:2 perhaps. And then I will trail when prices hits here. I've taken 800 pips already, and then as it comes here, I'll trail my stop, and I'll still have 1 position left running and trailing this market as it goes down, 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 because we don't know where this will ever stop. We might run more than thousands of pips when we took our trades up here, and we still have a position left. You'll always feel good about yourself looking right at the top here, and and noticing that you've taken the best possible entry all the way up here. So you need to decide if you add positions or if you trail positions. And if you are trailing a position, then you need to act as if that trailed position is a new position added to the market. Let me just move this. So every time you add to a position in the market, like we would look here, right? And say, for instance, our first position was there. Then when we take this position, or when we were about to take this position because of this break and a pullback here, then we trail, because we had 3 positions in the market, and we've taken off 1, so now we have 2 left. So the second position, we can trail it all the way down, and then here you can say, okay, we still have the 2 in there, and we'll keep it down. And then you might take the second position completely out once you've reached 1:2, and then you have your third position still left running. And then here is a pullback down, and now you're waiting for it to pull back here, looking for a position there. Stop loss is up there now, yeah, with 1 position left. So in this area, you've already taken like 800 pips or whatever. instead of adding, unless you want to continue with one position per trade, whereas you've taken your trade there, then you wait every time for a break pullback. That's my next one, that's my next one, and that's my next one, keeping on banking all of it. There's nothing wrong with that, with any of these. So the guys who know me well, they know I've struggled with the risk management for a very, very long time. Yeah, the trading was absolutely perfect. The strategies were perfect, but because of greed, you want to squeeze every last bit out of this thing. And I still want to squeeze the last bit. And this is why I have this one position running, even though I've taken profits up here already. Yeah, I've taken my trade here, and then I've taken profits there. So it's definitely going to be a trial and error of what you are going to like. And I don't use exactly the same thing all the time. But it's going to be on a, definitely before I pull the trigger here, I'm going to already know what it is I'm going to do. And a lot depends on my playing field, on where my target is going to be. I don't know. I think that's quite a lot. Do you want further clarification on that? I'm going to open the mics quickly for questions about this one. I actually don't. Johirul, when it gets to the end here, then I would add less. Let me just show you the reasons why. This is where I'm putting on up here is where I'm putting on most of my idea, because my goal is to get up to the end here. Right? But now, as we can see here now, there's a trend line coming down. So I've taken my profits all in this area. So now we're getting very close to the goal here. So for me, the ideas is becoming weaker and weaker now. So this would be my next opportunity here. So what I mean by next opportunity is either to take another trade here, or I would now move my stop loss of my last position up further down, as if I'm taking another trade here. But in actual fact, I'm not. I've taken all three here. I'm just moving it down, banking some more profits as I'm going down. I don't like increasing anything as it goes, as it gets here. Let me see. Okay. So in this case here, we have a barrier here, and also, taking a trade as this 633 here is a goal, right? So it's come down and it's reached that goal. So if you get another opportunity here, I wouldn't add to that position really, because we've already come here. This is why I mentioned in the fourth video that taking the first trade after the trend line breaks, after that trend line breaks, you drop down to the 4-hourly chart then, and then that first opportunity after the trend line breaks, is what we are really after. We are in a good place if this is going to start happening, because then we might get that trend going down. So this is the area I'm looking at trading. And then dropping down my stop loss. So I've taken off some profits initially and then moving the stop loss down to this area here, above this 30, above the 200 and above everything here. And then just trailing that down all the way down, as if you are taking trades, as if you're looking for a trade here. It would be nice to know what you guys will do. So for that reason, I'm going to ask you for the homework to redo the trading plan of how you will trade. Are you going to trend? Are you going to trail 3 positions, or are you going to treat every position as just one single position? Yeah. And are you an aggressive trader or not? And I would like to know what risk you're going to use as well. Yeah, you mean, Johiro, when you say you're looking for a trade there, yeah? So prices are coming, it comes down in your favor, and you're looking for a trade there. So it's again, it's up to you whether you want to add, because we're still looking at this area closely when it gets to this trend line, because we are either going to take our entire position off the table, even the ones that we had previously here, because this is not working perhaps. Remember, we are basing the idea that it's trending. And if there is no trend down, then we're going to get stopped out. Our whole idea started off that we're going to aim for this 800 pips all the way at the bottom. We were aiming for this 800 pips from here, and how it gets there, it's trending. So we're looking at every time prices gets to this level, it comes down, it comes down, it comes down, it comes down. So we are waiting for that same move again. But as it gets closer and closer here, we need to realize that it's coming down in a trending fashion. So we need to try and identify the trend. And if the trend is not working, like here we can see on the 4-hourly, the trend it's gone up. So we were looking to trade again short here at this area, and then that might have been a stop hunt, and it looks like it's going down. But because we are so close to a goal here, adding another position here might be the wrong idea. But if this fails here now, meaning that it's looking as if we're getting a move up here, then your final stop loss might be hit, and then you are done. This is just the area where you would now start trailing. You look at you can look at the EMA from the point there and measure up and say, oh, that's 24 pips. And how about the next one here? That's about 30 pips there. So you can now look at this one here, measure it from there. That's 50 pips there. So it's gone a little higher up than usual. So your stop might have been hit here. And prices are going down. But again, depending on how aggressive you are, you can also start trailing based on the previous highs, and then rather trail your stop based on the previous high and the 36 going all the way down. But I don't like taking the trades when it's so close to my initial goal, which was identified on the weekly chart as 800 pips. If I've already got 700 pips, and I'm not trailing, then I'm not going to add another position to that. I'd look for something always in the market when we are, when we're just starting off, where we're looking at our initial trade, like on the daily, prices are heading up into the level of importance here, and it's diverged. That is the first trade, and in my second trade and third trade. But this is where I become more interested, and I really only add to all these positions or trail if I am in that trade. So if prices are here now and it breaks through, like here we have now a trend going down. So if prices now, if I wasn't looking for a trade here based on the 633, then I wouldn't really be bothered looking for the break and that pullback here as my second opportunity, because I'm not in the trade here already. I'm always looking here first and then trailing it up, and looking there first and then trailing it down. Adding 3 positions here, and then the idea is to get up to that level over there. Like in this case, it's done it quite nicely. And the trend was identified nicely on the daily. So in this case, the 36 EMA was a good idea. As we can see, it's nice. And if you draw the trend line, you draw it along the 36, and then that is the angle. Yeah. So now you have it on top there, and then you try and keep that angle as close as possible by touching it. So my new trend is actually here now. So looking for a trade up here would be a good idea, or, you know, trailing it, or trailing your last position down there. But if your idea is to go long, then that's what needs to happen, and you needed to get in here already. Okay, do you have any questions further on the risk management side? You can see it's very important to have the risk idea already formulated before doing anything. It becomes complicated, and, you know, more so when you are in a trade, not knowing what to do. So this is where the plan comes into play. Have a plan either for your whole trading journey, or at least have a plan per trade idea. And there is no problem by just adding positions one at a time. One trade here, one trade here. Like if you look at this whole trading idea, you've risked more than 1% really if you want. You can add 0.2% here, 0.2, and as it gets down, you say, no, it's too close here, I'll add 0.1% risk here. So you can add that whole thing up, and it could be 1% risk. And you could be making profits on the way going down, which means it's a free trade, no risk at all. And you can use that for looking for another opportunity to trade. Yeah. Every time you're looking for the breaks and then the pullbacks. So if you can identify this stuff, you can just add trades there, or trail your stop of your initial idea. Is that clear, guys? Okay. Okay, it's great stuff. So for the homework, find out what sort of a trader you are, and I mean, really, yeah, find out if you would have taken the aggressive trade, or if you are taking it aggressively or not when you are in a real situation. When I draw the stuff on the board here, it's not the same thing. It's like with a demo account. Yeah, you don't know whether you'll take the trade there Whether you'll take the trade here with your stop loss all the way up here, and you don't know whether you'll just drop that here. You don't know until you're really doing it. And if you find yourself as an aggressive trader, yeah, then do the adding the position, add every time you add a position into there. Treat this as a new one all the time, because that's what an aggressive person would do. Yeah, but do it less, because remember, the guy who's got in here with his trade idea, he's got in with maybe 0.5%. And you're going to end up here with much more, because you're going to get in and in and in and in and in. So give it less, 0.1%. Because your trade idea is the same as his, really. It's just that he's doing it a different way. Okay. So if there aren't any further questions on this one, then I'm going to end it here. Mark, do you have anything else that you want to add here? How the risk management relates with the psychology, perhaps? No. Okay, then, guys, I'm going to leave it at this, and then do that homework. Do a plan, an entire plan that what you do in every single trade. Are you going to take it aggressively? Are you going to trail it, or are you going to add positions as it pulls back, break, pull back, break, pull back? Yeah, what will you do on each of those? Yeah. Okay, guys, thanks a lot.